We all know that debt affects our ability to borrow more money, but do you know that it slows our financial journeys down beyond this? Or do you know how to get rid of debt? Welcome to Forever Finance, where we look at forever freedom. Debt. It's a word that can strike fear into the hearts of many, but it's also a tool that, when managed properly, can be used to build wealth and achieve financial goals. However, when debt spirals out of control, it can wreak havoc on your financial well-being. Let's start with the often overlooked aspect of many parts of personal finance, especially debt. Debt isn't just a financial burden, it can weigh heavily on your mental well-being. The constant worry about bills, interest rates, and creditors can take a toll on your mental health. While debt can provide temporary relief by allowing you to purchase items you couldn't afford otherwise, it often comes with a heavy psychological burden. The constant stress of owing money, the fear of not being able to meet payments, and the feeling of being trapped can take a toll on your mental well-being. Studies have shown that high levels of debt are correlated with increased levels of stress, anxiety, and even depression. The feeling of being trapped in a cycle of debt can be overwhelming, leaving you feeling hopeless and powerless. It can affect your sleep, your relationships, and your overall quality of life. Debt has a profound psychological impact on individuals. It can erode their sense of control and self-worth, leading to feelings of shame and inadequacy. Many people internalize their debt, viewing it as a personal failure rather than a financial challenge. However, there are steps you can take to alleviate the mental strain caused by debt. The first step is acknowledging the problem and seeking support. Whether it's talking to a trusted friend, family member, or seeking professional help, opening up about your financial struggles can provide much-needed relief. With how many people are impacted by debt, opening a conversation to those closest to you could help relieve issues for them as well. Practicing self-care is also crucial. Engage in activities that help reduce stress, such as meditation, exercise, or spending time with those closest to you. Taking care of your mental health is just as important as managing your finances. It's essential to take a proactive approach to managing your debt. By taking control of your finances, you can regain a sense of empowerment and peace of mind. While debt can feel overwhelming, it doesn't define you. Another significant impact of debt on personal finances is its ability to tie up your cash flow. When you're burdened with debt payments, a significant portion of your income goes towards servicing those debts, leaving you with less money to cover essential expenses or invest in your financial journey. It creates a cycle where you're constantly playing catch-up, struggling to make ends meet month after month. As the cash flow continues to be tied up from debt, there is a risk that you take on even more debt in order to cover your regular expenses as you live from payday to payday. Breaking free from this cycle requires a concerted effort to reduce and eliminate debt. Seeking assistance from a debt management counselor can be beneficial in helping develop a debt elimination plan. They can help you negotiate with creditors, explore debt relief options, and create a customized plan to get out of debt faster. By taking proactive steps to reduce your debt burden and manage your finances wisely, you can reclaim control of your cash flow and pave the way to a brighter financial future. Debt consolidation, a term often accompanied by promises of financial relief and simplified payments. But is it truly the financial miracle it's made out to be? Let's delve into why debt consolidation may not be as good as it sounds. Before we can do that, what exactly is debt consolidation? Debt consolidation involves taking out a new loan to pay off existing debts, combining them into a single regular payment. While this can lower your regular payments and potentially reduce your interest rates, it doesn't address the underlying issue of overspending or living beyond your means. In fact, for some people, debt consolidation can even exacerbate the problem by providing a false sense of security and freeing up additional credit that may be tempting to use irresponsibly. It's crucial to consider the underlying implications. One common pitfall of debt consolidation is the temptation to continue borrowing without addressing the root cause of your debt. It's like putting a band-aid on a wound without treating the infection beneath. Without addressing overspending habits or poor money management, consolidating debt will only result in more debt. Debt consolidation loans often come with fees and charges that can add to your overall debt liability. What's more, securing a consolidation loan may require security, putting your assets at risk if you're unable to repay the loan. Another downside of debt consolidation is the potential that you will be paying more money towards the debt over the time of the new loan. For example, if you have a credit card that has $10,000 owing with an expected payback time of 5 years, then you consolidate this into a home loan. While the home loan interest rate will be much lower than the credit card rate, your 5-year expected payback time is now the 30-year time frame of the mortgage. This lower interest rate at 6 times the original payback period will result in you paying back more as a result of this debt. Like most things in personal finance, debt consolidation is not a one-size-fits-all solution. While it may benefit some individuals, it's essential to weigh the pros and cons carefully and explore alternative debt repayment strategies. So how can you tackle your debt and regain control of your finances? There are several methods you can consider depending on your individual circumstances and financial goals. One popular approach is the debt snowball method, where you focus on paying off your smallest debts first, while making minimum payments on larger debts. As each small debt is cleared, you gain momentum and motivation to tackle the next one, ultimately snowballing towards debt freedom. Another effective strategy is the debt avalanche method. This entails prioritizing debts with the highest interest rates, tackling them first to minimize the amount of interest paid over time. While it may require more discipline up front, it can save you money in the long run. Negotiating with creditors is another avenue worth exploring. Most people don't know that many creditors are willing to work with you to develop a repayment plan that fits your budget. Whether it's lowering interest rates, waiving fees, or extending payment terms, don't hesitate to reach out and discuss your options. Regardless of the method you choose, seeking assistance from a financial advisor or debt counselor can provide invaluable support and guidance along the way. They can help you develop a personalized debt repayment plan, negotiate with creditors on your behalf, and provide ongoing accountability and support. Lastly, it's essential to recognize that carrying high levels of debt can significantly impact your borrowing capacity. When lenders assess your creditworthiness, they look at your debt-to-income ratio, which measures the amount of debt you have relative to your income. Debt eats into your disposable income, leaving you with less money available to meet future financial obligations. The higher your debt-to-income ratio, the riskier you appear to lenders, and the less likely you are to qualify for new loans or lines of credit. Even if you are approved, you may be offered less favorable terms, such as higher interest rates or lower borrowing limits. Accumulating excessive debt can also signal red flags to lenders, raising concerns about your ability to manage additional debt responsibly. Even if you have a high income, a high level of existing debt can make lenders hesitant to extend new credit to you. Additionally, carrying a significant amount of debt can limit your financial flexibility and restrict your options in times of need. Whether it's unexpected medical expenses, home repairs, or job loss, having too much debt can leave you vulnerable and ill-prepared to handle emergencies. This can make it more challenging to achieve important milestones such as buying a home, starting a business, or pursuing higher education. It's essential to be mindful of your borrowing capacity and avoid overextending yourself financially. Before taking on additional debt, consider whether you can comfortably afford the payments and how it will impact your overall financial well-being. By reducing your debt and improving your financial health, you can increase your borrowing capacity and unlock new opportunities for yourself as you progress along your financial journey. Debt can have a significant impact on your personal finances, from its toll on mental health to its effect on cash flow and borrowing capacity. By understanding the consequences of debt and taking proactive steps to manage and eliminate it, you can take control of your financial future and achieve your financial journey goals. Always remember, financial success is within your reach, and with the right knowledge and discipline, you can achieve your financial goals. If you found this video helpful, please subscribe to Forever Finance to stay updated with more valuable content. Please consider liking this video to help it reach more people. If you have any topics you would like us to cover, leave a comment below. Thank you for watching, and we will see you next time on Forever Finance.